What if everything you were told about debt was incomplete? What if a country could follow the rules, join the world's most powerful economic club, and still end up poorer, weaker, and more trapped than before? Here's the mystery. In 2001, Greece joined the Eurozone. It was hailed as a triumph, a return to Europe's economic core, a guarantee of prosperity, stability, and modernity. Less than a decade later, Greece was bankrupt in all but name. Pensions were slashed. Hospitals ran out of supplies. Unemployment exploded. Young people fled the country in record numbers. And yet, here's the part that doesn't make sense. Greece didn't collapse because it stopped paying. It collapsed because it kept paying. So, how did a modern democracy, inside the European Union, end up sacrificing an entire generation to service debts that never seemed to shrink? And more disturbingly, is Greece an exception or a preview? To answer that, we have to rewind decades before the crisis, to the quiet decisions that sold the future long before anyone noticed. To understand the Greek debt crisis, you have to understand Greece's contradictions. This is a country that invented democracy, but spent much of the 20th century under authoritarian rule. A country with deep national pride, but persistent institutional weakness. A nation with a powerful cultural legacy, but a fragile economic foundation. Post-war Greece, survival first, structure later. After World War II, Greece was devastated not just by Nazi occupation, but by a brutal civil war that followed. By the late 1942, infrastructure was destroyed. Institutions were weak. Political polarization ran deep. The Marshall Plan helped Greece rebuild. But unlike Germany or France, Greece never developed a strong industrial base. Instead, its economy leaned on tourism, shipping, agriculture, small family businesses. This worked barely, but it left the country vulnerable. The social contract that would change everything. By the 1982, Greece faced a choice. After decades of instability, democracy returned in 1974. In 1981, Greece joined the European Economic Community, the precursor to the EU. And then came a new political era. The government expanded. Public sector jobs, pensions, welfare programs, state-owned enterprises. These weren't bad ideas in isolation. They were meant to stabilize democracy and reward a population tired of hardship. But there was a catch. Greece didn't raise taxes enough to pay for them. Instead, it borrowed, and borrowed, and borrowed. The hidden weakness, borrowing without discipline. Unlike countries with strong tax enforcement, Greece had widespread tax evasion, weak collection mechanisms, political incentives to spend rather than reform, and debt slowly rose, but markets didn't panic. Why? Because Greece still had its own currency, the drachma. If things got tough, Greece could devalue away, inflate, regain competitiveness. It wasn't ideal, but it was a pressure valve. That valve would soon disappear. In the 1990 seconds, Europe had a bold idea: a single currency, no exchange risk, no trade friction, no devaluations. The euro was supposed to unite Europe economically and politically. For Greece, joining the euro wasn't just economic, it was symbolic, a declaration. We belong at the core of Europe, the rules of entry, and the illusion of compliance. To join the Eurozone, countries had to meet strict criteria: low inflation, budget deficits under 3%, debt under 60% of GDP. Greece didn't qualify. So how did it get in? Through a mix of creative accounting, optimistic forecasts, and financial engineering. Later investigations revealed that deficits were underreported, sometimes with help from international banks using complex swaps that hid debt off the books. At the time, markets didn't ask many questions. Why would they? All Eurozone debt was treated as nearly equal. Greek bonds were priced almost like German bonds, and that changed everything. The cheap money flood. Once Greece adopted the euro in 2001, interest rates collapsed. Borrowing became effortless. Capital poured in them. For the government, this felt like free money. Instead of reforming, the public sector expanded. Wages rose faster than productivity. Pensions became more generous. For households, credit exploded. Consumption surged. Imports skyrocketed. For the economy, growth looked strong. Deficits widened. Competitiveness eroded. But none of this showed up immediately. The euro removed the warning signs. No currency crashes. No inflation spikes. No market discipline. It was like driving faster, with the speedometer removed. The Olympic moment. In 2004, Greece hosted the Olympic Games. It was a triumph of national pride and a financial disaster. Costs ballooned. Projects ran over budget. Facilities were abandoned soon after. The debt piled up, but again, no alarm bells, because Greece was European. Because markets believed no Eurozone country would ever be allowed to fail. That assumption would prove fatal. The global financial crisis of 2008 didn't cause Greece's problems. It exposed them, the shock that changed everything. As banks collapsed and investors panicked, attention turned to government balance sheets. Suddenly, deficits mattered again. In late 2009, Greece's new government made a stunning admission. The budget deficit wasn't 6%. It was over 12%. Later revisions pushed it even higher. Markets reacted instantly. Interest rates spiked. Bond auctions failed. Confidence evaporated. Greece was locked out of borrowing, and now, without its own currency, it had no escape. The trap of the euro. Here's the key problem. Countries in the Eurozone can't devalue, can't print money, can't set independent monetary policy buoys. So when Greece lost access to markets, it couldn't inflate its way out. The only option left was internal devaluation. That means cutting wages, cutting pensions, cutting spending, raising taxes, all at once. During a recession, this is where the crisis stopped being financial and became human. In 2010, Greece was officially rescued, or so it was said. The Troika arrives. Greece received bailout loans from the European Commission, the European Central Bank, the International Monetary Fund. Together, known as the Troika, the conditions were severe. Austerity, structural reforms, privatization, pension cuts, tax increases. The justification? Restore confidence. Make Greece competitive. Reduce debt. But here's the critical detail most people miss. Most bailout money never went to Greece. It went to foreign banks, bondholders, financial institutions. The bailouts were less about saving Greece and more about preventing contagion. Greek debt was transferred from private investors to public institutions. Losses were socialized. The economic freefall. Austerity hit an already collapsing economy. Between 2008 and 2016, GDP fell by over 25%. Unemployment exceeded 27%. Youth unemployment surpassed 60%. This wasn't a recession. It was a depression. And it made the debt problem worse, because as the economy shrank, the debt to GDP ratio rose. Greece was paying, but never escaping. Statistics can't capture what happened next. Healthcare and survival. Hospitals faced shortages. Medicine, staffer, equipment. Preventable diseases returned. Mental health crises surged. Suicide rates increased dramatically. The lost generation. Young Greeks faced a brutal reality. No jobs, no prospects, no future. Hundreds of thousands emigrated. Doctors, engineers, scientists. Human capital gone. This wasn't just an economic crisis. It was a demographic one. Democracy under pressure. Political extremes surged. Traditional parties collapsed. Trust in institutions evaporated. radical movements gained ground. When people feel economically powerless, democracy weakens. Greece learned that the hard way. By the late 2010 seconds, headlines declared Greece recovered. Growth returned. Bond yields fell. Markets relaxed. But look closer. What recovery really meant? Yes, deficits shrank, but largely because spending was slashed. Investment remained weak. Yes, tourism rebounded, but tourism alone can't rebuild an economy. Debt remained enormous, and much of it was now owed to official institutions with long maturities but strict oversight. Greece hadn't escaped. It had been locked into a slower, quieter form of dependency. Greece isn't unique. The pattern repeats. Cheap money, rising debt, delayed consequences, a sudden loss of confidence. Today, global debt is at record highs. Interest rates are rising. Growth is slowing. Many countries face the same trap. Borrow in good times, lose flexibility, pay forever. The Greek crisis wasn't about irresponsibility alone. It was about incentives. About systems that reward short-term comfort over long-term resilience. And about what happens when debt becomes destiny. 3 takeaways and a warning. So what should we learn? Takeaway 1. Cheap money is never free. Low interest rates hide risk, they don't remove it. Takeaway 2. Debt without growth is a trap. If borrowing doesn't build productive capacity, it builds dependency. Takeaway 3. Economic sovereignty matters. Without control over key tools, adjustment becomes punishment. And here's the warning. The Greek crisis didn't begin with collapse. It began with comfort, with small compromises, with ignored warnings, with the belief that this time is different. It never is. Call to action. If you found this breakdown valuable, consider liking the video to help others find it, subscribing for more deep dives into hidden economic history, and commenting below, what country do you think could be next and why? Because understanding the past isn't about blame. It's about recognizing the patterns before they repeat.